Hello, this is Kirk Spano, Margin of Safety Investing and Fundamental Trends. And I am going to make this more of a Stocks of the Week piece this week. There are not a lot of options to be selling, and I'm going to show you why real quick. If you take a look at the volatility index, it's not very high. And usually when the volatility index is high is when you get the best premiums. It usually means that some stocks are beat up. So that's good for you to get things cheap. And you can get really, really good premiums by selling puts basically at the money. And I don't see a lot of that right now. So volatility, yes, volatility has not really jumped up yet. I think it is going to. I think we're going to get one more drive up into here with the VIX index getting over 30, maybe approaching 40. We'll see. The target is way up here, which is basically saying that it is compressed in a way that it's going to go boom, 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 bam. Okay, you got that? Boom, 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 bam. So we've had the boom, boom, and maybe we're going to get a bam. If you were a Milwaukee Bucks fans in the 1980s, Marcus Johnson helped influence my speech patterns when he said that, sometimes you've got the ooh, but not the or maybe it was the and not the ooh, but whatever. Volatility should surge. Be ready to sell cash secured puts sometime in the next month. Hard to know when, but I do think that we are going to get that volatility event. I don't know if it's going to be a response to the Fed. I don't know if it's going to be a response to the debate. I don't know if it's going to be a response to aliens. I have no idea. The biggest thing I fear, I mentioned this a few months ago, and I have kept my mouth shut about it because I just don't want it out in the universe. But I do think that there is possibility of a terrorist attack. We'll see. Supposedly the Iranians want to come back to the negotiating table on the nuclear deal. I think this is because they're aware that Israel might be ready just to kick their ass. Hard to know. But I don't want to see anything horrible happen. I'm just not so convinced that it won't. Mike Morrell was at that conference I was at. I think that was his name, the guy that whispered in Bush's ear during 9/11. And he said that it wouldn't surprise him to see a terrorist attack. So we'll see what the powers that control some of these countries and organizations indirectly cause to happen. We'll see. But if we do get a huge volatility event for whatever reason, you're going to want to sell puts on that, because the interest rate cycle that is starting is going to be a huge, virtuous economic cycle, and it's going to go like this. You're going to have interest rates get cut. You're going to have $1 trillion to $2 trillion of money market money that is the money of not mom and pop, because they don't have it, private equity and hedge funds and developers that are just waiting for the internal rate of return on projects that they have had sitting for over a year become good enough to bring on other investors and take their skim, right? Because on all those deals, the general partners get 20% off the top, just like the SPACs work, just like hedge funds work. 20% is a pretty standard number. I'm not saying it's right. I'm just saying it's what is. And that should generate a lot of development. You put the bank financing on top, you get 4, 5, 6, maybe $10 trillion of real estate and industrial development over the next 4, 5, 6 years. And you really just have a huge boom. So that supports employment, that supports commodities, that supports GDP, that supports tax receipts. The lower interest rates plus the higher tax receipts make servicing the debt a lot less onerous. So I think we have a big positive economic cycle. The stock market will follow, because of course we need the stock market to go up too to generate those tax receipts. We know that the correlation there is very, very high. And ultimately, this all leads into the boomer retirement crisis at the end of the decade. But between now and then, I think it's going to be pretty good. And if history rhymes, it means things will get really overheated at some point. and then we can run for the hills. And the braver among us can try to bet on a downturn at some point 3, 4, 5, 6 years out. I hope that it's closer to 6, because the bigger it is, the more we can make between now and then, and the more obvious the correction or crash becomes. It is very difficult to pick out crashes and corrections because crashes only happen every now and then. See this chart I have on there, 2020. There's lots of corrections, but if a correction is less than 20 to 30%, it probably wasn't very predictable, and you probably shouldn't have done anything about it, because when you sell, it generates taxes. So unless you can really save more than what you'd pay in taxes, usually the best thing to do is just collect your dividends as they come in, build a little cash pile over time, and then when you get one of those little corrections, rather than having tried to predict it, you just react by investing your cash. And that, buying the dip, has worked forever, ever and ever, forever and ever and ever. And so you should just keep doing it. Now, if we do get one of these things where I say sell almost everything, like I did in January and February of 2020, then you sell almost everything. You have a big pile of cash, and you can just wait for the lower prices. Or, again, if you're a brave, adventurous soul, you can bet on a decline and try to hit a grand slam without anybody on base. It's hard to do, but you can do it every, once a decade, give or take. All right. So I expect volatility to jump up, and that's when we're going to want to sell cash secured puts. I think it happens by October, in the next 6 weeks or so, maybe 7 weeks, 6 or 7 weeks. And then as we go into the election, the market usually starts to stabilize, and then it usually rallies right after the election. And sometimes the rally starts, and I believe in 2016, it started pretty much right at the election. But normally there's a really good end of the year and start of the next year after a presidential election, right? There's a lot of hopium, a lot of promises, and then we all get disappointed later on. All right, so the only option that I'm really interested right now is monitoring Palantir, which is a stock that we bought under $10 a share that is now on the S&P 500, or will be in the next couple of weeks. The announcement was over the weekend. And I've asked Shooter and Teresa by email and on the Fundamental Trends chat board to post some charts for me, including Palantir. So I want to see where Palantir is likely going to top out here in this rally for the S&P 500. Remember, the S&P 500 acts as a magnet. So now you have people front running that magnet, and the magnet's about to turn off. What do I mean by that? So once the S&P 500 ETFs, VU and SPY, and I forget what the iShares one is called, IVV, when they make their orders to buy these shares, and I think it's over the course of a week, might even be starting now, you get that buying pressure. As soon as they've got their allocation, right, the 1 or 2% or whatever Palantir is going to be in the index, then that's it. All the hoovering of shares is ended. And then you have a lot less support for the shares. So sometime in the next week or two, I think you want to sell covered calls on Palantir. If you've got a triple here or more, you probably even want to trim some. Maybe trim a sixth of your position, or a quarter, or a third, maybe even half of your position. And I don't think that that's a bad thing to do, especially if this position has grown to 6, 7, 8, 9, 10% of your portfolio. It shouldn't be that much. It should be a half position at some point, 2-ish%. I think that Palantir will beat the indexes over time, but I don't think they're going to crush the indexes over time. I think they're going to be good-ish to great-ish, kind of like that B+, A- range. I don't think they're an A+ stock anymore. I think that this run from 9, I think it was when we bought it, up into the 30s, that was your big move. Maybe you get another $10. Hard to know, but I wouldn't be looking for this one to go to 100. So it's not going to triple again. So I'd be looking at covered calls. I think the December 40s are what I'm targeting right now. I'm not positive. Let's see how far this runs. I mean, if all of a sudden the stock is in the 40s, they may just sell, more of it. So let's keep an eye out on this. But I think December is going to be the month. It could be November, it could be January, could be a little bit of each. I think $40 is going to be the target, but maybe it's 45 or 50. We just don't know yet. Let's see what happens to Palantir over about the next week. AAOI is a stock that I doubled down on a while back, right? I sold some other mid caps, I sold some other micro caps and said I'm going to double down on this one. So I did. Since I did the double down around $10 a share, and it's up, and I think probably we're getting to the range where we want to sell some. That's the target is 17. It's up to about 12. So this little rally here, if it happens, if it gets up to about 17, 18, that's where you're going to take some profits. It doesn't have much of an option market. So just so you're aware, I wanted you to be aware, hey, I said let's double down in here. We did. It's rallying. The rally should go to around here, middle teens. That's where you maybe take the new money that you put in there. You take your profits on that, and then you just keep the original position as a starter. So keep that in mind. All right. So what did I publish this week? This week I published the punch card dividend stocks at both websites. And I changed the format a little bit. I'm not going to show all of these stocks on the computer here because I think people should have to subscribe to see these. But I am going to talk about them. So let me move some stuff around on my screen so I can read off of one while you're looking at the other. Now, I think that this virtuous cycle starts relatively quickly. I think you're starting to see deals get rehammered out right now. And I don't say I think that because I'm guessing. I say I think that because I know it's happening. I know that we're doing it. I know that people I know are doing it. I know that there's moves all over the country. I've called several people over the weekend. They all said, yep, we've been waiting on these deals. They're already kind of like half ready to go. And I just got to sign new contracts, get stuff under contract, finish up with permitting. In a lot of cases, the permitting was done already. So there's a lot of things ready to go pretty quick. I'd say by Q1 of next year and even Q2. It'll really take off in Q2. So keep an eye on that because as you start to see real estate development really take off next year, that is going to just push all sorts of things. And I think employment is going to be, everybody's talking about employment getting worse. This is it. This is as bad as it gets. I think this is about as bad as it gets over the next few months going into Q1. And that's it. That's just it. You're going to see a lot more people working in construction and real estate development. A lot of the immigrants are going to be doing it. All the skilled trades people, they already don't get any time off. They're going to be working overtime. So you're going to see a lot of stimulus to GDP just from development and redevelopment. It's going to last years and years until towards the end of the decade. The clean energy development. I was just studying Brookfield. Don't want to talk too much about it. Talking about one of the Brookfield companies that is in the punch card dividend stocks. They have just a tremendous pipeline. You're looking at 12 to 15% growth on a fat dividend paying stock. So it is one that I am trying to get into on the volatility that I expect. I bought two other REITs today. One where I can go and take my vacations, and the other one that can build my stuff. So I bought an industrial REIT today with about a 6% dividend, maybe 6.5%. And I don't think the dividends are the most important thing. I think it's can I keep getting the dividend? Can it keep growing? Will they buy back shares? Do they have the growth profile to support the income rising over time along with a rising share price? And I think that this industrial REIT does that. I love their footprint. They have big holdings in Wisconsin and the Midwest and the Great Lakes region and Nashville. I just love what they're doing. Northern California, they don't have much in Southern California, but the other REIT that I'm looking at for industrial does. And if that price comes down, then we'll add that one. I talk about the 6 REITs that I want to add. I added 2 already. And I don't think that you should be cherry picking. I don't think you should be trying to be too cute or too perfect. I think you just buy the basket. You figure out a way to get into all 6 of these stocks, in addition to the other REIT that we already own that's up 30%, 40%. What is it? Innovative Industrial up since we bought it about 30%, right? Plus the dividend was 10% yield for us from where we bought it. So, I'm looking at these stocks as a position trader, right? I wrote the Grandpa Stocks article, and I told you I don't think there's really very many forever stocks. I think there's 5 forever stocks in the entire S&P 500. 5. And there's probably a handful more that are smaller, but it'd be hard to project that right now. We're going to look back and say, oh, I wish I would have bought those 5. But, we're doing our best. There's only 5 large cap stocks that I think are forever stocks. Everything else has an element of cyclicality, and you have to understand it, and you have to buy when these cycles are in the trough and just starting to rebound. Why do you wait for them just to start to rebound? Because sometimes when they're in a trough, they fall off one more cliff, right? The knife falls off another countertop. So I have moved towards waiting for the uptrends to start. I think that is a psychologically easier thing to do. And mathematically, I think it works out, because for all the times that you buy something and you bottom ticket versus the times that you buy something and it falls off the cliff one more time, I don't know that it's worth the angst to do that very often. I mean, every now and then, but for the most part, just wait for the uptrend to start. Wait for a little retrace. You buy it, right? You catch your double and triple bottoms, and then off to the races it goes. Or in a lot of cases, the hype cycle, it's not off to the races, but rather just a 2, 3, 4 year growth pattern that FOMO's at the end, and that's when you sell. So we're looking at these position trades over the next 3, 4, 5 years, I think. And that's what we want to own. We're looking for the things that have some beta. When you're at the bottom of a cycle, you want to buy beta, right? Because the beta means that you'll get more volatility to the upside as well. So you're buying cheap on the bad beta, and then you're riding it up on the good beta, right? Beta goes both ways. It's just volatility. So I've got 19 dividend stocks, some that I own, some that I'm buying, some that I'm getting ready to buy. One of them is a delivery company that I think that you should be very, very aware of. It pays a big fat dividend. You recognize their trucks, right? I mean, there you go. Narrows it down to 3 companies for you. You're going to recognize their trucks. Some of these stocks that I'm looking at, they really benefit not just from the new economic cycle for real estate because of falling interest rates, but also they benefit from AI. And that is the other big theme, is what companies are going to benefit from AI. And I've got a number of them, some of them we already own, and then some new ones. And if AI is going to help a company increase their margins through robotics or machine learning or customer service, then, all of a sudden you have companies that they have their normal growth rate, whatever that is, and now they don't have the costs associated with that growth anymore, or maybe those costs associated with the growth go down, right? So expanding margins. I think that the Federal Reserve, it could have been somebody else, but I thought it was a Federal Reserve paper, suggested that earnings growth was going to slow down dramatically in the next 5 years, really get cut roughly in half. I don't think that's true. I think earnings growth is going to stay about the same as it has in say over the last 5, 6, 7 years. We had this little flat period for a couple of years, but I think it's going to go back to the 5 to 10 year trend of earnings growth of upper single digits per year. And I think that's going to happen because the labor issues are easily fought with immigration. So if we're smart, we manage labor shortages with immigration. And if we're smart, we allow AI to take some of the lower end, redundant, low skilled jobs. And if we're really smart, we pour money into education and training so that all those people who are going to lose low end jobs and middle management jobs can do something else. So there is something that we have to do to prevent unemployment longer term, and that is tell people, hey, education and training is basically free, and you can keep your food stamps and unemployment going while you're in these training programs. It wouldn't take much for everything to work perfect. We just have to get by the rhetoric. I think if I'm right about this election, and I'm pretty sure I'm going to be right, then most of those things happen. Will it ever be perfect? No, because you got to keep enough people disaffected so they vote for you. But ultimately, as I think President Trump has proved, when promises made to certain groups don't work out over multiple generations, they start to look elsewhere. So I think there has to be delivery on those promises now. If not, then we'll get another snapback in 4 or 8 years. So I think that everything's moving in the right direction. I think there's a wild card that could break it with a spike and crash scenario, but 10 years out, is clean energy and AI still in about the same place? Probably. It's just a matter of how the line wiggles. And we're going to try to play that out. We're going to do the best we can. Right now, there aren't a lot of stocks that are cheap as far as the ones that I'm interested in. So I have 19 dividend stocks. It looks like I'm going to have 18 growth stocks, and that'll be out in the next week. So take a look at these punch card dividend stocks. I'm adding them to a lot of accounts. I really like the industrial REIT that I just bought. I really like the hotel REIT that I just bought. I think that they have private equity style upside. I think they're about to break out. There is a pipeline company that took me years to really start to like, and I think I'm there finally. And they're on a little bit of a pullback. I think they're within $1 or $2 of me wanting to buy them. Kinder Morgan, I took off the list because, we were buying that when it was 13, 14, and now it's 22. So that one I'm not buying anymore. In fact, that's something that you should be looking for an exit on over the next year or two. I haven't checked on Richard Kinder's health. Maybe you take a look at that. Because, like I said, when he dies, the family's going to sell those shares to somebody. And my guess is that it ends up being a deal with like Williams or somebody else who will say, okay, we'll write the check for the family's shares, and Kinder Morgan will get absorbed into Williams, or maybe one of the other pipeline companies or a private equity firm. Hard to know, but I think that's coming. So again, I haven't done the death watch on Richard Kinder, but he has a lot of shares, and his family will sell those shares when he passes away, because that's how they get the step up in basis, presuming that is still law at the time. So we will have to see. There's a pretty good chance that next year there are a lot of major M&A deals, just in case they get rid of some of the giant tax breaks on multi-million and billion-dollar transactions. All right, so that's about it for today. I have the major markets interview with Shooter that I'm going to edit today. So you're going to get a whole drop. I'm just editing videos today and tomorrow. I do have to run and take care of my car because we had a little problem there. My grandmother died. So the next few days I'm pretty busy. I will be in the chat rooms, and I implore you, get into the chat rooms because there's a lot going on there now. And I think that it's very helpful. I do drop in some ideas, but take a look at punch card dividend stocks. On Thursday, we have the September Q&A webinar. Normally, I'll be doing these on Wednesdays. I think maybe I'll switch them to Thursdays. But this week it's on Thursday because I do have the funeral on a Wednesday. So submit your questions underneath the article so that I see them and I can prepare for them, and ask about anything. It'd be relative to your portfolio. And again, nobody knows who you are here. So go ahead and ask questions. Just give them enough detail so that I really understand what you're getting at, right? I need to know things like your cost basis, percentage of your portfolio, why you own it, right? Describe why you own something, why you bought it, when you bought it, how much of it you bought, what it's worth to you now, and talk about your risk tolerance, right? Put a good, 4, 5, 6 sentences in here. Don't just say, "What do you think of Palantir?" Well, Google it, right? It's in here somewhere. So, if you want to ask questions like, "Hey, I bought Palantir at 9. I bought it for 3% of my portfolio, and now it's 10% of my portfolio. My risk tolerance is pretty high, but if I can't triple my money again, what would you be doing?" Something like that, right? All right. Have a good rest of the day. I think that we are going to have a big options expiration update, and keep an eye on this. When volatility spikes, and it looks like it's gonna, then that's gonna be your chance to write a lot of cash secured puts and make a lot of money. So if you have cash, sit on it. If you don't have any cash, take a look at your portfolio, and maybe it's time to trim a couple of things just a little bit. But I'm pretty heavy in cash right now, and I think that for most people you should be. My ETFs are 40% money market right now, so get ready. You're gonna get a volatility spike. I don't know how high it gets. I mean, my guess is into the 30s. If it breaks 40, then you just start buying with both hands. All right, take care, everybody.